A balance sheet is one of the fundamental financial statements that provides a snapshot of a company's financial position at a specific point in time. It is a summary of a company's assets, liabilities, and shareholders' equity. The balance sheet follows the accounting equation, which states that a company's assets must equal its liabilities plus shareholders' equity. Here's a breakdown of the key components of a balance sheet and how it reflects a company's financial position. Assets. Definition. Assets are the economic resources owned or controlled by a company that are expected to provide future benefits. Categories. Assets on a balance sheet are typically classified into two main categories: current assets and non-current, or long-term, assets. Current assets include cash, accounts receivable, inventory, and other assets expected to be converted into cash or used up within 1 year. Non-current assets include property, plant, equipment, long-term investments, and other assets with a useful life of more than 1 year. Liabilities. Definition. Liabilities represent the company's obligations or debts, amounts owed to creditors, suppliers, and other entities. Categories. Liabilities are also classified into two main categories: current liabilities and non-current, or long-term, liabilities. Current liabilities include short-term obligations such as accounts payable, short-term loans, and accrued liabilities that are due within 1 year. Non-current liabilities include long-term debt, deferred tax liabilities, and other obligations with a maturity period exceeding 1 year. Shareholders' equity. Definition. Shareholders' equity represents the residual interest in the assets of the company after deducting liabilities. It reflects the owner's claim on the company's assets. Components. Shareholders' equity is typically composed of common stock, additional paid-in capital, retained earnings, and sometimes other components like treasury stock. Common stock represents the par value of shares issued by the company. Additional paid-in capital, amounts received from investors in excess of the par value of the common stock. Retained earnings, accumulated profits or losses that have not been distributed as dividends. The accounting equation. Assets equals liabilities plus shareholders' equity. Assets equals liabilities plus shareholders' equity. Interpreting a company's financial position. Balance. The equation must always balance, reflecting the fundamental accounting principle that a company's resources must be financed either by debt, liabilities, or equity, shareholders' equity. Liquidity. The composition of assets and liabilities provides insights into a company's liquidity. Current assets are expected to be converted into cash within a year, providing a measure of short-term liquidity. Debt levels. The balance sheet shows the company's debt levels through both current and non-current liabilities. A high level of debt may indicate financial risk. Equity position. Shareholders' equity represents the owner's residual interest. A healthy and positive shareholders' equity position indicates the company's ability to cover its obligations and sustain operations. Investor and creditor perspective. Investors and creditors use the balance sheet to assess a company's financial health and risk. They may analyze the debt-to-equity ratio, current ratio, and other financial metrics derived from the balance sheet. Overall, a balance sheet provides a comprehensive view of a company's financial position by detailing its assets, liabilities, and equity. It is a critical tool for stakeholders to assess the company's solvency, liquidity, and overall financial health.